It's Brian Preston, the Money Guy.
The next question we have is from Leslie. She says, and this is a situation a ton of people are in now, including me and Nate. So I'm excited to see how you answer this, Brian. She says, my sister and I are now in the financial position to purchase our first home, but interest rates and housing prices are continuing to increase. Mm-hmm. Any advice for first-time home buyers seeking to buy in 2022?
Yeah, this is, I think it's so interesting, this weird world. We talk about this a lot among the content team as well, because, y'all have heard me talk about Team Crash. I think it's important for me to share that this does depend geographically to where you live, but overall real estate right now is so unique because we have an inventory crisis. If you think about, because I think a lot of people on Team Crash remember 2008 through 2011, where housing markets, the whole housing market got crushed. I've shared earlier that my house the house I had in Georgia went from like over $500,000 down to $250,000 almost overnight. The difference between this housing market now in 2022 versus what we had in 2008 through 2011 was that we overbuilt back then. But and that's why we had tons of inventory. There wasn't a lot of demand for all that supply that was out there. So the impact, going back to basic economics, was the price got crushed. Well, fast forward to 2022. Let's look at our situation. Right now, I know here in the Nashville area, we're way behind on inventory, meaning that there are way more people needing a house than the supply of houses that are available. So if you can just take those same basic principles, demand is ultra high, supply is ultra low. The only thing that can give is prices are going to go up. So that definitely will have a big impact. So, and then, by the way, this is not just a Nashville problem. I saw in a recent study that America as a whole is about 4 million homes behind where we should be. Because realize, I think the ripple effect was from that 2008 to 2011 real estate collapse was a lot of people got really scared. A lot of people went out of business. Banks didn't want to give out the money as easily because they got burned on real estate. So it built this situation to where now we're sitting into where we didn't keep up with the supply of homes like we should have. So, and now look, I think a lot of people think, okay, interest rates, they're raising interest rates. The Federal Reserve's raising interest rates to fight inflation and some of these other things that are going on. Maybe that will drive the housing costs down. Well, once again, we go back to the basic economics example that I was given. If you have people moving to your area and, with demand and the supply is just low, I don't know that interest rates, yes, that could slow it down because maybe less people are trying to move at that point. So maybe it does take down pushes down the demand with higher interest rates, but it probably doesn't fix the inventory issue. So Leslie, here's the unique thing. I think that if you don't have to move in the next 12 to 18 months, it's okay if you just kind of wait to see what happens. Because I know right now we feel like we're on this hockey stick ride where you're seeing housing prices going up. I mean, I was going to say aggressively 20 to 30%, but I know in places like Nashville, we're seeing even numbers much higher than 30% appreciation. That's not sustainable. That's more of that hockey stick. I don't think a year or 2 years from now you'll see houses have doubled again. That just seems just wild to me. So I think it's okay to understand that if you don't have to make a decision right now, you can wait to see if this thing will levelize out a little bit. But I will tell you, I don't think it's going to go down. Now, if your time horizon is super long, that where you and your sister are trying to move to, you'll be there for 15, 20 years in the future, you can be a little more aggressive with saying, okay, I'm not going to sit on the sidelines any longer, because time on itself, especially for a personal use asset, will massage out a lot of this volatility that we're going to be experiencing in the coming decade. And it probably will also help you in the short term with interest rates are probably going to continue to go up. I do expect, because I think a lot of people have this false sense that, a 5% mortgage is a high mortgage. No, historically, that's still not a high mortgage rate. I mean, my first house in the 90s was 6 3/4, and I thought I stole it. I mean, because it was just such a good rate to me at the time. We've just been spoiled with these 2 and 3% interest rates. So I don't even think that the market will completely freak out with a 5% mortgage rate. So that's why I know I'm speaking because it's such a specialized answer. So let me summarize this a little better in the fact that if you can wait, I think that that's not the worst thing. But if you have to buy a house or you're just dead set that you're going to do it, I would then do a check to say, how long am I going to be in this house? Because you don't want this to be a 5-year or even a 7-year decision, because if it's a short-term decision, you're much more likely to get burned by this huge run-up in housing versus if you're going to be there for an extended period of time. The longer your time horizon, the more grace you get on the jumping into this process. But this is just a unique thing that I think will levelize. I mean, I don't think prices will crash, but we could see prices come down 5-10% because the market got ahead of itself on the pricing. When you're going through a hockey stick moment, it's not uncommon for there to be a little frothiness to it. I'd also pay attention because I don't know, Leslie, where you're coming from. I know in the past, cities like Las Vegas or the whole state of Florida, when they do these skyscrapers and these high rises and these condominiums and other things, they do tend to overbuild in those type of situations. That maybe in those unique markets where they are going vertical, maybe there's an opportunity there, but I mean, I'd have to look at what the demand is in that area. But I would pay attention to all those factors, and then don't forget to go back to the basic economics of supply, demand, and then the price impact of all that. Do that same type of analysis that you heard me just do in this Q&A and compare that to your specific marketplace, and I think that could help.
Yeah, that was a great question, Leslie, and a great answer, Brian. And I'd say you said people were scared after 2008, and construction companies were one of the groups that was scared, and they're not building like they were back then, at least not yet. So, and with our huge housing shortage, it might not be the same as it was back then. But great question, Leslie.
Yeah, I mean, we lost South Atlanta. Most people I knew in South Atlanta worked in the construction industry. That's one of the reasons it was a double whammy. Is they got those businesses went away, so that's why housing didn't recover as fast. So really geography means a lot in this whole real estate thing. You always hear about location. We're both from Georgia, Daniel. That definitely played out. Whereas here in Nashville, in this Franklin area that we live, because I studied this market from 2008 to 11, it only got beat up by 10% at the most. Whereas in Atlanta, it was a 50% drop. So geography definitely plays into this. Pay attention to migration patterns, pay attention to inventory in the area, and then how long you can stay there. And those can help you with figuring out, what you need to do.